Hey everyone, welcome back to Corporate Decoder. Today, VERU Incorporated just filed an 8K regarding a material definitive agreement, and I am seeing a clear signal about their fundraising strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. VERU is looking to raise a significant amount of money through stock sales, and this filing tells us exactly how. Alright, let's dive into what VERU Incorporated officially announced on July 2nd, 2026. They've entered into what is called a sales agreement. Think of this as a deal where they can sell their stock, their common stock, specifically little pieces of ownership in the company, for up to $21.8 million. This means they can tap into the market and sell shares of their common stock, which is currently trading on the Nasdaq under the ticker symbol VERU. This isn't a one-time thing either. They can do this from time to time as they see fit, essentially having a standing offer to sell shares when the price is right or when they need cash. The shares being sold are registered under something called a Form S-3 registration statement. This essentially means they've already told the Securities and Exchange Commission, or SEC, that they plan to sell these shares in the future. This particular registration became effective back in April of this year, and the prospectus, which is like a detailed brochure about the offering, was filed on the same day as this 8K report, July 2nd. Now, who are they selling it to? Well, they've appointed Oppenheimer & Company Incorporated and Canaccord Genuity Incorporated as their sales agents. These are essentially investment banks that will help them find buyers for these shares. They'll be acting as designated sales agents when VERU instructs them to sell. VERU is not forced to sell any shares. It is completely up to them. The sales agents will do their best to sell these shares, but it all depends on VERU's instructions. They can specify price, timing, and how many shares they want to sell. This type of sale is often an at-the-market offering. This means they are selling shares directly on the stock exchange at the prevailing market price. It is a way to raise capital without the fanfare of a big, single event. For their efforts, the sales agents will get a commission. They are set to receive 3% of the total money VERU makes from selling these shares. On top of that, VERU has agreed to cover certain expenses for these agents and provide them with standard protections like indemnification against certain liabilities, including those under the securities laws. Now, attached to this filing are some important supporting documents. There is a legal opinion from Reinhard Borner van Duren SC regarding the validity of the shares they are issuing. This is standard practice to ensure everything is legally sound. The actual sales agreement itself is filed as an exhibit. This is the definitive document outlining all the terms we've discussed. And of course, there is the interactive data file. This is like a digital, machine-readable version of the report, which is becoming standard for SEC filings. Looking beyond the filing itself, VERU Incorporated is in the biotechnology sector. They have a market cap of about $49 million, and the current stock price around $3.06 as of early July 26. Recent headlines show they were in the news for launching this very $21.8 million offering. There was also significant news on June 5th about a clinical supply deal with Novo Nordisk, which apparently sent their stock price soaring over 160% at one point. This offering, so soon after such a positive development, suggests VERU might be looking to capitalize on that upward momentum, or perhaps fund further development spurred by the Novo Nordisk news. This type of at-the-market offering is a common tool for biotech companies, especially those that might be burning through cash for research and development. It allows them to raise money flexibly. However, it can also put pressure on the existing stock price as more shares become available. Historically, companies that repeatedly use these kinds of offerings can see their share count grow significantly, potentially diluting the value for existing shareholders if the company does not grow its earnings or valuation at an equivalent or faster pace. One of the key things to watch with VERU is how they use the capital raised. Is it going to fuel significant breakthroughs, like the one hinted at with the Novo Nordisk news, or is it simply to cover operational costs? The company has a relatively small number of employees, around 20, which suggests they are a lean operation, likely focused intensely on their drug development pipeline. What this filing really tells us is that VERU is actively managing its capitalization. They are prepared to sell more stock to generate funds, which can be a positive sign of proactive financial management, but also a signal that they may need substantial cash injections to progress their business objectives or to navigate periods of uncertainty in drug development. The fact that they can tap into a registered offering means they've already done a lot of the groundwork with the SEC, making it easier to execute quickly when opportunities or needs arise. Ultimately, VERU's strategy here is about maintaining financial flexibility. The question for investors is whether this flexibility translates into successful product development and profitability, or if it becomes a perpetual cycle of share issuance. The mention of a new offering soon after significant positive news like the Novo Nordisk deal, while potentially opportunistic, also raises the question of whether they are fully seizing the moment or if their cash needs are substantial and ongoing. That is my take. Stay decoded. If you found this breakdown helpful, please hit like and subscribe for more. Tools I use for research are linked in the description.